When you buy a house with a mortgage, you do not just pay for it once. You can end up paying for it nearly twice, sometimes even more. And most people never see it coming. It is not a scam, it is just how mortgages work, hidden in plain sight inside your monthly payment. Once you understand it, you can save yourself a staggering amount of money. First, the basics. A mortgage is simply a loan to buy a home. You borrow a big chunk of money from a bank and pay it back slowly, usually over 15 or 30 years. And here's the catch that keeps you honest. The house itself is the collateral. If you stop paying, the bank can take it. That is what makes a mortgage different from other loans. For most people, a mortgage is the single biggest loan they will ever take on, which is exactly why understanding it can be worth more than almost any other money lesson. Your monthly payment is not one thing. It is actually 4 things bundled together. People call them PITI: principal, interest, taxes, and insurance. Let us break down each one, because understanding where your money actually goes is what separates people who overpay from people who build real wealth with their home. First, principal. This is the actual amount you borrowed. Every dollar of principal you pay back is real progress, lowering what you owe and building your ownership. Second, interest. This is the bank's fee for lending you the money, based on your interest rate. Interest does not lower your loan at all. It is purely the cost of borrowing. Your interest rate might look like a small number, just a few percent. But on a loan this big, stretched over decades, those few percent quietly add up to a mountain of money. Now here's the part that shocks everyone. In the early years of your mortgage, almost all of your payment goes to interest, and barely any goes to your actual loan. You can pay for years and watch your balance barely move. It feels like running in place. This schedule is called amortization, and it is heavily front-loaded with interest. Slowly, the balance tips. Each payment chips a little more off the principal and a little less to interest. By the final years, most of your payment finally attacks the loan. Let us put real numbers on it. Borrow $300,000 over 30 years, and depending on your rate, you can easily pay back a total of $500,000 or $600,000. That extra couple $100,000 is pure interest, going straight to the bank. That is why your rate and the length of your loan matter so enormously. This is also why people refinance. If rates drop, you can replace your loan with a cheaper one and save on interest. Just watch for the fees involved in doing it. Now the other 2 parts. Taxes and insurance, often handled through something called escrow. Instead of paying them yourself, a slice of your monthly payment is set aside. The lender holds that money and pays your property taxes and homeowner's insurance for you when they are due. It spreads 2 big yearly bills into smooth monthly chunks. This is why your mortgage payment can rise even with a fixed rate. If your property taxes or your insurance go up, your escrow portion goes up right along with them. So when you budget for a home, never look at just principal and interest. Always include taxes and insurance, because that full PITI number is what really leaves your account. Here is a cost that catches many first-time buyers. PMI, or private mortgage insurance. If your down payment is less than 20%, the lender usually makes you pay it. And here is the kicker. PMI does not protect you at all. It protects the bank, in case you stop paying. You pay extra every month purely to lower the bank's risk. The good news is PMI is not forever. Once you have built about 20% ownership in the home, you can usually have it removed and shrink your payment. This is why the down payment matters so much. A bigger down payment means you borrow less, pay less interest, and can avoid PMI entirely from day one. A common target is 20% down, but do not panic if you cannot hit that. There are loans that allow much smaller down payments. Just know PMI may come along for the ride. You will also choose your rate type. A fixed rate stays the same for the whole loan, so your principal and interest never change. It is predictable and safe. An adjustable rate can start lower but change over time, which means your payment can jump later. For most people, the certainty of a fixed rate is worth it. Then there is the length. A 30-year loan has a lower monthly payment, but you pay far more interest over time. A 15-year loan costs more monthly but saves a fortune in interest. A shorter loan is like ripping off the bandage. It hurts a bit more each month, but you escape the interest trap years sooner and own your home outright far faster. There is a middle path too. Keep the flexible 30-year loan, but choose to pay it like a 15-year whenever you can. You get lower required payments with the option to crush it faster. So how do you beat the interest trap? First, you get the best interest rate you can. And the biggest lever for doing that is your credit score. A higher score can save you a fortune. Second, put down more upfront if you can. Third, choose a shorter term if the payment fits. And fourth, make extra payments directly toward principal whenever you have spare cash. Even one extra payment a year, aimed straight at principal, can knock years off your loan and save you tens of thousands in interest. Small moves, enormous results. And remember the upside. As you pay down principal and your home value rises, you build equity, which is the part of the home you truly own. That equity is real wealth. Every principal payment quietly moves money from the bank side of the house to yours. A mortgage, used wisely, is one of the most common ways ordinary people build real wealth. Just be careful not to buy more house than you can comfortably afford. A payment that strains your budget turns the dream home into a constant source of stress. Let us recap. A mortgage payment has 4 parts. Principal and interest pay off the loan, while taxes and insurance flow through escrow. Early on, most of it is interest. Avoid or remove PMI by reaching 20% ownership. Get the best rate with a strong credit score. Consider a shorter term, and make extra principal payments to crush the interest. A house can be the biggest purchase of your life, or the biggest interest trap. The difference is simply understanding where your money goes, which now you finally do. The wealthy do not fear mortgages. They simply use them with their eyes open, minimizing interest and building equity, instead of just drifting along on autopilot. So now I want to hear from you. Are you saving for your first home, or already paying a mortgage? And did the amortization trick surprise you? Drop it in the comments below. If this finally made mortgages make sense, hit that like button, subscribe for more simple money lessons, and share it with someone who is about to buy a home.